Welcome back to the Bear Trap Podcast. My name is John Kirby. My co-host is Vic. All charting credits, as always, go out to Ak. Hope you guys like this one. Please subscribe if you haven't already. And see you in the next one. Yeah. You there?
Yes. Just had someone right at the beginning of this flush the toilet right next to me. So that's what you're hearing.
No, but we're basically just talking about Jen Carson and because you guys know we look at his podcast, his stuff a lot. He sort of is the kind of like founder in some way, like from a social media perspective of looking at Gex stuff, looking at looking at the vol space for retail traders. And the theory that we're kind of espousing is that it's not, or at least Vic was making the really excellent point, that it may not be out of the goodness of his heart that he's making all this information public.
And you just said it was baiting.
Okay, I did just say it was baiting. Yeah.
But I said it wasn't out of the goodness of his heart. I think some of it is, but I think he's a cold-hearted, businessman. The way he's going about it, just from the stuff that I've heard. And you said out there putting it out there as baiting, but his predictions usually come true. So is it more of like a self-fulfilling prophecy? He's putting it out there. I don't know.
Dude, it's the same. It's the same as what Hindenburg Research does. It's the same as what a short seller does. It's just a really fancy method because, right? Think about it, right? You get short a shit ton of stock, then you publish your short sellers report. Everybody realizes that the stock is shit, right? Which is what just happened with Square or Adani Group or whatever. Damn thing tanks. You make a ton of money. Okay, what Jem does, which is different and actually kind of clever, is he says I remember a while back, he was like, on this Tuesday, the market's going to turn around. Or he says like, don't short the market during this period. And then what we've been noticing, and I talk to Tux about this all the time, is that the window moves around in the sense of like a lot of times he'll make a prediction. At first, the predictions were right on the money. And lately what's been happening is it's always a couple days early, a couple days late. And so if you just look at the Gex, if you're doing it yourself, you'll get the timing right, which I've done for a couple cycles, not even knowing, because like I wouldn't even listen to Jem and then I'd just be like, I just sort of start to load up when the prices looked good and then I'd catch it. But then I'd go back and like listen to Jem's predictions and be like, oh, damn, he said that this was going to start, 2 or 3 days later than it actually did. And then like I remember that, I wish I had the dates in my head, but and then if you had actually gotten in when he said to get in, you would have made like 1.5% or something like that instead of like 7% or something like that in terms of the move on SPY.
So do you think he's actually front running his own call?
That's exactly what I think.
He's going, hey, it's on a Tuesday, and then he's loading up the Friday at the lows.
100%. Yeah. And it makes perfect sense to do something like that because if you know that the supportive flows are there, right? And then you make a call about the supportive flows, and you know that everybody else is going to try to front run the supportive flows. Then you can front run the front running of the supportive flows, and then we're in 3D chess again.
I was thinking about that exact thing yesterday. I'm going, all we're doing over here at the Bear Trap, for the most part, is literally just trying to find out what the dealer flows are up to, and just ride the wave. But I think there's a lot of people doing that, right? So it's like not anything different in a way. It's maybe just a more precise, scientific way of doing it, I guess, than just riding like a 10 EMA or something. You know what I'm saying? Because isn't that what we're doing? We're just kind of basically trying to figure out where the dealer flows are and just be on that side of the market.
Yeah, or I mean, it kind of depends, right? Like if like in this past period where it's like the dealer flows are kind of like meh, right? And then we were talking about it. We're like, okay, it's just going to ping pong between, what do we say, 95, 400, 390, 400.
We said 390, 400. That's what I texted you last night. I was
we did.
After that podcast we did last week, we basically said, first chart we put up, I think, was just the SPY OI. And we just said, it just looks like 400 to 390.
You can literally just buy one of those levels, close your eyes, and
and it ended up working out almost literally to the T.
Did I make any money off of it, Vic? No, nothing.
Well, me neither. I mean, I was. until yesterday, but yesterday,
Oh yeah. Dude,
yesterday's move,
I actually did well yesterday, oddly
you
enough.
did.
I mean, I didn't really do anything. I just bought, you know how I think I was posting in the Discord, I was like, yeah, I want to do a risk reversal on the XLF, and then Tux messaged me and he's like, that is the last thing on earth that I would do right now. And I did it pre-FOMC, which was a very bad idea. Took it off right before the conference, and then yesterday at 390, I put it back on.
So you
Um,
bought XLF yesterday?
I bought like
Dude, me
actually I did.
too.
Oh, really?
Yeah. But I bought some calls for like 3 weeks out or something.
I didn't buy calls. I literally just bought. I actually ended up buying shares.
Yeah.
Um,
No, I think it's a good idea. I think so. We'll talk about that. So that's something we should talk about is how this, the banks, the bank vol that's in the market right now, I think is going to come out.
oh yeah,
At
it's
least,
gonna come out, and then tech is gonna have to deflate at some point, and they're gonna just like it's gonna move the other way.
well, then you think about, okay, so for how long have folks been piling into tech because of, my guess is it's just a rotation from banks, because tech's not really at, I don't know. We got to talk about that a little bit more because tech's not really exposed that much to the bank crisis.
No, in fact, it's actually the banking crisis is bullish for tech. But we can
Exactly.
let
But
me
once that
circle
ball comes out, yeah, let's go.
let me circle back and finish the gem discussion because I want to make another like a final or a point, I don't know, caveat, whatever, which is I've had another discussion with a buddy and which we were talking about it from a completely different point of view. So you remember the call that he made a while back where he was like, yeah, I'll buy long duration gold calls,
Yeah. Oh,
um,
yeah.
which was a
Yeah.
great call.
Yeah.
And then I was talking to my buddy and I was like, well, is he actually trading that? And you could also say, well, he's probably not trading it because if you think about it from a risk reward perspective, like you were saying, the risk reward for him is publicity and getting more people into his fund. The amount of money that you can make reliably by getting more people into your fund is, from a risk adjusted perspective, so much better than actually trading anything.
Yeah. Well, okay. I know. I get what you're saying. It's like you think of a Kathy Wood. She gets paid no matter how many billions she's losing.
Yep.
As long as she's got money coming in, it doesn't really matter. She could buy and sell, Tesla all day long, and it doesn't really matter. So is it the same thing as that, where it's just, hey, I just want to grow the fund, but the fund's got to make money too. So you don't think
Yeah,
the
it's
fund
probably
is taking advantage, and all he ever talks about is taking advantage of the probability distribution, right? Certain parts of the distribution, and he talks about how gold, it was essentially the fall trade of the last 20 years, where people were buying it to hedge, and it never worked, and so now they're not. So that's why he says the gold calls were such a good play because they're just so cheap and nobody's in it anymore.
no, and
Now you're
I
seeing
don't
gold go
think
crazy.
I think it's also in his favor, right, to be saying things that he believes to be true. It's just a question of right, let's think about this from a trader perspective, which is that it's not binary, right? Like he's going to benefit from some diversification, right? The best RR is going to be from getting his best RR trade is going to be getting more people, getting more money into his fund, like the Kathy Wood thing that you were talking about. But it doesn't mean that he shouldn't diversify. It doesn't mean that he shouldn't also trade to some extent, but probably less than we think he does. Right.
I agree. And this goes back to something we always talk about, how being an analyst versus being a trader are almost two different things. And he may be on that side of it right now, where he's just the analyst.
Yeah.
And he's just saying, hey, this is a great play, but he doesn't actually take the trade himself, or maybe his traders in his fund are actually just doing it or doing some version of it or whatever.
Exactly. Like at that point, like
Yeah.
if you're like how'd you call it? An over 9,000 level copy, then
Yeah.
are you taking your trades yourself? Nah, you're on the phone, you're talking to people, you're like, hey man, do this, and they're like, all right, sounds good.
Yeah. How much nicer would it be if you had some situations set up like that? We've talked about that before, I think.
Yeah, we talked about the designated driver idea.
Yeah.
Well, that's what I'm calling it now, right? Where you have one buddy who's not trading in your group of traders, and that buddy's the one doing the objective analysis.
Yeah, and then everybody else, you just execute the trades.
Yeah, people have been asking about us making videos of like actual trading, actionable ideas, and I'm not opposed to that. Like I'm totally down to do it. I think what everybody's going to find though is that trading is really, really boring. Like the actual mechanics of it.
Yeah, it is.
So it's almost like I'm happy to make that content, man. It's easy to make, but I mean,
Well, I think you should. I think we should drip some of that in here because people just need to have an idea of how we're going from the analysis and connecting it to a real live, real world situation. Like, and everybody's gonna be different. Every account size is different. So that's why you can't go, oh, well, he just did this, so I'm gonna copy it. You can't do that. It's just not possible to copy it. But it could give you an idea. Like, hey, John likes to sell puts and in this type of situation. Well, it doesn't mean you go sell the puts that he's selling or that you go sell puts, go sell credit spreads or
yeah,
go buy calls or just go buy shares. I mean, everything's expressed in
yeah,
a
like
different way.
that's a good point. Like in a normal, if this were sort of a normal, I don't know, environment, I probably wouldn't have bought shares. I probably would have sold puts on the XLF and tried to collect that premium. But to be honest, I'm like, damn, the XLF actually looked pretty good at these prices. I wouldn't mind holding this. I want the dividend. I'm thinking, about the next 5-10 years. So it's
Think
a
about
completely different. Yeah.
Okay, so going back to selling puts in it too, is your risk higher or lower if everything goes bust? That's the question. If they don't fix the banking situation, there's still a small chance that happens. So
Yeah, so I actually took more risk by buying the shares.
buying the shares, yeah.
Yeah, and it's but there's a reason for it. So this is actually kind of a weird discussion because there's a lot of thinking that actually goes into this like seemingly really simple decision. So if I sell the puts, right, I'm essentially agreeing to buy the XLF at a lower price than it's currently trading at, hopefully, right? Actually, necessarily, otherwise there'd be an inefficiency. But the issue with that is like let's say that the XLF like completely bounces, right? It goes like ballistic to the upside. Then all of a sudden, all I'm going to do is I'm going to collect that premium and I'll have missed out on my shot to buy it.
Mm-hmm.
So if I don't do a risk reversal, in other words, if I don't buy calls on it at the same time as I'm selling the puts, then I'll miss out on that.
Right.
So my original trade on the XLF was a risk reversal. But then I think that there's this other scenario, which is also quite probable, which is the XLF does nothing, right? It just sits in the same place for a long time. Like we're talking months here, which is totally possible. And if that happens, then all of a sudden your risk reversal, you're going to make no money on it. And yeah, it's like there's no real point to having it because it's essentially just neutral. And you're still having the risk of the XLF tanking on you, and you're not holding the shares for that protracted period of time, which would enable you to collect the dividend sooner rather than later. So
yeah, I get what you're saying.
There are scenarios in which buying shares make more sense than selling puts. There aren't a lot of scenarios like that, but they happen every once in a while.
Okay, so where and why did you decide to buy it? Decide to buy it at this level? Like that may be a question somebody's really trying to get into is why you decided to buy. Why did you execute the trade like you did?
So my thinking is, and this is kind of like very back of the envelope type thinking, but either, right, the mini banking crisis is over, and this thing is gonna kind of either it's like slowly gonna trend back up again or whatever. I mean, it's probably like 1.5 standard deviations on a weekly 10 period or something like that. So it's quite low right now in terms of what it's been priced at historically. Or the banking crisis is going to get worse and this thing is just going to die completely. That's why I actually only bought half. So I'm entering into a position and I know that I actually want double what I currently purchased. And so this seemed like a really good midpoint to get some. And in terms of like where I bought it specifically, right, I bought it at SPY 390 just because we know that that's a really, really significant level. And there's some sector rotation going on, right, where, like you said, we're talking about everybody's rotating into tech right now. And then I think that that's going to start to swing the other way. So I'm very happy to buy the XLF at this level because it seems like either it's going to fall off a cliff or it has to go back. And that's actually where most of the opportunities are. It's where people are so uncomfortable that nobody wants it.
All right. All right. Let's get into this skew chart here.
Yeah.
Because
sorry.
we'll probably bring some of those other thoughts. No, it's okay.
Okay.
We'll probably bring some of those other thoughts into the discussion of these actual charts. And maybe how we would take some trades or kind of how it ended up playing out. This right here, I believe, when was this done? This was done yesterday at 7:30.
Yeah,
Basically
7:30 on the 24th. Yeah.
I wanted to bring this up and then the pre-market SPY chart. And so I always like doing this every once in a while just to see what the updated OI skews and GEXs look like before the market and then how the market played out. It's kind of an exercise to see like, oh, wow, if I ever see this profile again, or if I see this situation again, then I have a good idea of what it's going to do for the day and who's exposed or whatever. So in this situation here, I mean, I'm looking at this skew and I'm going, it's looking like probably an IV crush coming in because there's no events. And I always think about, what could be the catalyst that caused the skew, basically, highlight where that skew is for Friday.
Yeah.
And what would cause that to, pull away from sort of the mean IV level, which is like around 22% or whatever. Is there something that could cause it? If there's not any events or, anything like that, then I'm just going to assume that IV is going to come down. Okay, if IV comes down, what's going to happen to, say I'm in a put position and IV comes down, what's going to happen to it?
Yeah, you're going to have to bail.
You're going to take pressure, right?
Yeah.
Doesn't mean you bail. I mean, you don't bail right away. And that's something I've learned is it takes a long time to get people. It feels like folks hold on to their positions longer when they're in a loss. And so, and I think that's just a psychological thing. And a lot of times puts are held as insurance anyways. So you kind of already expect them to go to zero. And I used to hear this a lot with in another chat room is this guy would buy puts and hope they go to zero. That was the point because he was super long on the market. And he was like, I'm buying these as insurance. I hope they go to zero. And I think a large majority, because we always think of all these bears out there, and we kind of make fun of bears because they're always wanting the market to crash. And I always think of it as like it's just an insurance contract, and people are just hoping it goes to zero. So if we look at it from that standpoint, they're going to just hold on to the contract, so they're not bailing. But what's happening to the dealer? The dealer is going to have to start buying back those shorts that he's hedged with, right? But when does that start happening?
I agree, and I kind of, but like with I don't know, with a little bit of an asterisk, because the thing is, like, what we've seen about the market too when we're reading the sketch charts, and I know you know this also, but like it's that it's almost as if the puts move the market, at least in these cycles, more than anything else. So what's weird about it is if you talk about it like an insurance policy, then people get the impression that it's not the thing that is performing the like the magic, right? It's not moving.
Okay, hold on. The 100%. And the reason I said that was just that people hold on to them longer.
Mm-hmm.
And in that, so okay, IV comes down. Well, okay, well my puts just died, but I'm super long the market on something else, so I don't really care about the put. And the only thing that moves it is those dealers that were short on the other side.
Yeah.
Because that's all the flow that's in the market right now. Go to the next chart. Go to the SPY.
All right.
Sorry,
well,
I'm gonna cut you off there.
No, it's all good. It's the GEX one.
Yeah, the GEX one. I think this is the.
Let me make sure it's the same.
No, that's the
evening one, and then this is the one. Yeah.
There you go. Okay.
Oh, that one's so clear.
It's so clear, right? Because all right, so we got a lot of people, essentially a lot of gamma exposure to the downside, and we're right at our level, this 390 that we talked about last week, being essentially the range low for the week, based on just an OI, a simple OI picture. And so you're really overloaded here. And if IV comes down, what are the hedging obligations of the market makers into this GEX exposure? And there wouldn't be any, right?
Well, or they get absolved of their hedging obligations, so to speak.
Exactly, absolved of that's a good way to put it. So they don't need to hedge anymore. And if they already hedged other positions that are coming into the market at the open, those positions are, essentially going to be underwater. and the market maker, the dealer flow is essentially just going to be just to buy just to unload their shorts, right? They'll be buying. You'd be selling into positive dealer flow into a situation like this.
And I remember from the GEX on Friday, and I did actually look at that. It was 393, which was one of the biggest put strikes given where we were. And so it was almost as if these 390s were decaying until we hit 393. Big reaction off of it. But the fact of the 390 decay was sufficiently strong that eventually we popped 393. Once we pop 393, game's over. So let's say you want to do a highly leveraged futures trade or something like that. You would actually expect the initial fade off 393, wait for them to pop over, then you'd get long. And then you'd get long for like $1 to 394 potentially.
And so what I had said in my morning video was that there is a chance they tried to push this down to like 386, 387. But I would think that would just be a bear trap. But they couldn't even get it really under 390 with any kind of force. But it took a while. If you look at the chart of yesterday, it took a while for those 390s to decay enough to really cause the reaction. And that was my point earlier. The skew chart was that for some reason, it takes the next part of trading these type of GEX charts that I've learned is it just takes time for the decay to happen or for the charm.
No, you're
or for the
totally
Vanna.
right. And I mean, it's because it's also, I mean, if we think about it, right, we know this because if you've ever tried holding a 0 DTE option, you should kind of I hope none of you have tried, but you kind of know this intuitively that the decay is sort of it's kind of slow in the morning, right? I mean, you can look at this if you guys have ever gone to 0DTESPY.com or 0DTESPX.com, you can look at the way that they decay. And it's sort of slow in the morning. And then as you start to get into like 1 p.m., 1:30, this is Eastern time, obviously, that decay accelerates really quickly. And so it's almost exponential over the course of the day. So if you are holding puts in the morning, you're in less of a rush earlier on in the day to get out.
Especially if price is right at your strike.
Exactly. Yeah. In fact, every time implied vol pumps a little bit, you're actually in the green. It actually feels good. You feel like you're fine.
And I don't know if that's just I don't know how that works, but it does. It's sort of like a bait. It's sort of like keeping them interested in their position, and then they finally just pull the rug on them.
Yep.
And
I actually
it's maybe just a confluence of the charm and Vanna hitting at the same time. I'm not really sure, but it's probably what it is.
That's a really good way to put it. That actually makes a lot of sense. Confluence of charm and Vanna.
Because there wasn't a lot of Vanna. Go back to the skew chart.
Yeah.
If you think of Vanna as simply just being the IV effect on delta, then there wasn't a lot. There's the spread here between this yesterday and say Monday, and then the kind of like the mean IV here, it wasn't very large. And not to mention it's pretty left skewed as well. So, talking about, being from the top left to the bottom right, that skew is a little bit angled too much.
Yeah.
And so you're already going, well, it's probably an IV crush. How bad is it? It doesn't look like it's going to be that bad.
Yeah.
Because that spread's not that big. So there's not going to be a lot of Vanna. So it's really going to be sort of a charm day. If you think of it more of like a charm day, then it's going to be a while for charm, which is going to be the effective time on the deltas is going to be, you're going to have to wait a little bit longer for that move to come in.
Dude, that's a really beautiful way to put it. I hadn't thought about using these charts that way. Yeah.
Okay. So, and maybe we can get in more depth later with the way we can. I love how Ock put these historical IVs or historical volatilities and IV volatilities on there.
Yeah.
So those are really helpful, just kind of markers. But all right, go back to the SPY pre-market one.
Yep.
So with those thoughts in mind, we're going, okay, it's not really a Vanna day so much. There's going to be a little bit. It's more of a charm day. And then you look at the chart of SPY. Do you have a chart of SPY just like on a 5-minute? You probably don't right away, but yeah, pull one of those up because the picture starts to come together and you go, wow. It's like the whole thing that happened yesterday was just killing the 390s and 385s.
Also, don't
That's
judge me on my trading view, guys. I don't actually use it.
no, it doesn't matter. It's actually a naked chart is perfectly fine.
Okay, great. Yeah.
Go to a 5 minute on that.
Is it embarrassing if you're a trader to have just like a chart with nothing on? No, actually, it's a mark of excellence, isn't it?
That's what I was about to say. Like, if you don't have anything on your chart, I'm going, all right, it was a real trader here. This guy's learned that the indicators don't mean anything. All right, so then you get this this market move or whatever you want to call it, where you get a double attempt lower. So you get the gap down, and you get the double attempt into those 390s, and there wasn't a lot of IV, right? So they created some IV from the morning session. They created IV in the morning session, and then what happened? As soon as like that midpoint of the day hits, it's just nonstop destruction, right?
Yeah.
And it wasn't even the pop of 393. Now 393 could have been an important inflection point for everybody, and you can see right where that 393 is.
Dude,
the top.
Come on, it was. I was watching that because it did
was,
this thing, right? And they all thought
Yep.
it was the fade. It was like the fade, and then they ran it right back up, and it made perfect sense because it's like everybody was watching that level. So of course.
Yeah, and it was, yeah, and you're right, but it wasn't like it wasn't, the move actually came way earlier, right, at 390 on the third attempt, really lower. And anyways, the point is it was a charm day more than anything. That was kind of what I'm trying to say. And there was no events to cause any IV.
Well, and that's why this action was so grinding and stuff, right? It's because there was no, it was just the slow decay over the course of the day, and then you can see actually how it speeds up, right? At first, it's sort of like halting and whatever, and then as we get, what is this? It's literally, yeah, this is actually good. 1 p.m. was around here, 1:30 is right here. And I would say that this whole section of the day was very, very clear. That's when you started to get a trending day.
And I started saying in the chat, like, it's a melt up. It's a melt up, because you can just tell in the tape. Sorry about that. Turn that off real quick.
No worries.
But you can tell in the day that it by the tape that it's really just market makers buying.
Yeah.
It doesn't feel like there's any other volume except for just the market makers just buying the dips, and they really just bought like the 5 EMA or 9 EMA the whole way up.
Yeah. Well, and it's because there are those hedging thresholds, so to speak, right? Where basically what'll happen is this is a little bit of theory, but I'm pretty confident in this. It's like let's say you get that initial run up, right? Boom, boom, boom. You're all the way up here. All of a sudden they've already hedged out the entire inventory, so there's nobody to buy anymore. So actually natural sellers come back into the market because this was clearly an unnatural move. They come back in and the market moves down. As they move down, all the puts actually increase in value to some extent, except that increase in value is not fast enough given that we're late enough in the day to offset charm. Because it's not fast enough, then let's say that the beginning of this move is market maker driven, and then people start to think again, now it's like, okay, we're back to the trend. They start to buy it back up, same thing happens. And it's just this it's like this exchange, right? There's like the market maker deltas come in, and then people pick up on the momentum, drive it too far, market maker responsibilities go away, it comes back down, same thing again, just cycles. And then that's what we get. We get boom, 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 boom.
And now go to the end of day. Skew or Gex.
Okay. Skew.
All right. So can you guys hear that? Can you hear that background noise?
Yeah, but it's manageable.
I'm trying to block it out here. I'm gonna have to use my hand. This is such a ghetto setup. I'm literally right next to the heater. So turned it off and it won't shut off. I don't understand. But new house. Okay. So now we're looking at the end of day skew and what happened to the skew. Basically got crushed, right? And even Monday got crushed.
Yeah.
So all the positioning, and I kind of just visualize this in my head, but people were positioning for FOMC sort of from Wednesday out, right? Not everyone's just going to buy puts just for Wednesday. That'd be silly. Mm-hmm. And so a lot of the puts that were in the market were out into the future, probably not that far, but and that's kind of what I think of here is just like these were Fridays and Mondays and probably even Tuesdays puts decaying because of IV. And And then also, but you know what's interesting though is we look at that previous one. Look at that, the morning skew versus this one.
Yeah.
Did anything change with the future positioning as well? You can see the rest of the skew sort of flattened out a little bit.
2020.
So you see the angle of it sort of flattened out as a whole.
It did. I'm just trying to figure out whether the net reduced or not, because the center point here, it almost seems like these guys actually stayed elevated at around 22.5.
I'm saying the tails go up on the right side, the tails come down on the left side. They all start trying to normalize a little bit with that sort of main, that June 30.
Yeah.
June 16. But
the June 30, June 16 didn't move all that much.
They're kind of at a floor as far as where the price is, right with that IV.
Yeah.
IV. So that's why I say those kind of come into play. They sort of act like either upper and lower bounds or as a support resistance for volatility, which is an interesting way to look at it. If you kind of have an idea of where the support and resistance for volatility, this is where I came in talking about VIX being sort of an RSI for SPX demand for SPX puts. Is you can kind of find a support and resistance for the volatility, and it'll kind of give you an idea of if there's going to be Vanna, or if you're at the lows for puts.
No, that's a really good way of talking about it, and I think it's better than there's some other metrics out there, and they shall go unnamed, which don't really make a lot of sense to me for some quite expensive services, and this makes way more sense.
If you want to buy puts, right, you're wanting to buy them when they're cheap. Okay.
Yeah.
This is a simple buy low, sell high. So if you have an idea of when they're actually cheap from a broad market perspective, then you don't really need to know if the market is actually going to go down to those strikes or not, wherever you're buying. You just need to know if there's going to be an IV pump. So it's sort of like a mega play, I guess. But okay, go to the final SPY GEX.
All right.
For the closing, and look where it closed. It literally closed right above that SPY 395 negative GEX line. And this is just for the 98 days. So it's it's showing, all the GEX from Friday is already expired through here, but it closed right in this little tiny zone. So I found that really interesting too. It's climbing back towards that ball trigger in a sense.
Well, it's like, yeah, and it makes sense that we're going to come up and touch it again. I mean, we haven't quite gotten into this yet, but I think we were kind of playing on it where it's like, okay, what is this? Is this the new skew? Yeah. We're entering into a zone. I don't think we have a lot of events coming up, right? And it's sort of like there's still a lot of vol in the marketplace with not a lot of events, and then there's sort of like actually pretty low, if you think about it. And I mean, you can also measure this. I mean, look at where the HV20 is. Look at where the HV30 is. They're pretty low here. IV30 is substantially elevated.
Explain the difference between the two and why you think it's low. Like,
okay.
What is HV?
So yeah, HV is historical volatility. For those of you that use TOS, you can. It's literally called the historical volatility on TOS, and all it does is try to measure, the sigma of realized returns in the marketplace over some period of time. And it's basically like a measure of volatility that has actually happened versus implied volatility, which is how much volatility is priced into the options. And so whenever you see a huge discrepancy between historical and implied volatility, it means that people who have been buying a lot of options have not been doing very well, right? Option buyers have been doing very poorly.
So give us an example of what realized vol would be versus IV, and typically IV is higher than the actual HV, right?
Yeah, I mean, maybe a decent example would be like, okay, like let's say that you bought a call over here. Actually, I did this, so I can tell you guys exactly what happened. Actually, I bought it here. I bought an SPX 3970 0 DTE call right around here, around 390, maybe around here. And I remember the thing was trading at around $3. After this spike, it went up to $6. So when it was priced at $3, and actually it was priced quite well, because if you think about it, that call being priced at $3, we closed the day at 39.70.71, I think, on SPX. So if you had held that call for the entirety of the day, you would have actually lost $100, supposing that you bought it near low of day. So that's how you know that, like, that's one way of thinking about implied vol being higher than realized or historical volatility. It's that the options are overpriced relative to how much they're going to pay out for you.
Such a great example. Holy smokes, dude, that you just knocked it out of the ballpark with that.
Oh yeah. Well, so what's interesting is that, right, that thing went all the way up to $6, meaning that as soon as the market moved up here, all of a sudden we were pricing in, I would say more. I mean, you could either say more volatility to the upside, but also it's just that because the starting point for where we're going to move is higher, the probability that we're going to hit 39.70 also was elevated. So that's why the price of that option went up. But if you think about it, like that option was still at $6 here, even more overpriced than before. So the implied vols remained overpriced throughout the day, even though the day went up, because it didn't go up enough.
Yeah, perfect. Yeah. So most of the time, the market is going to price in a bigger move than what takes place, which is why you'll always, for the most part, not always, but see realized vol, the volatility that actually take place, be lower than what the market was predicting.
Yeah.
So it's an assumption you should build into the model that whatever you're using, if you're going to use this GEX idea or use probabilities of skew or IV, is always just understand that whatever the IV is, it's probably not going to move that much.
Yeah.
It may change. That picture may change, but what's interesting though is right now, if you look at that skew, based on this conversation, if you look at the skew, you can see the IV and the historical sort of in the same ballpark. It's still holding true, essentially, that, at least for the last 30, 20, and 60, they're about the same, like 20, 18%, something like that.
Yeah, I think, let me see, IV, HV, H20. Yeah, it got substantially closer. It's kind of there's this like rubber band effect, right? Where like implied vols will get way higher than historical or realized vols, and then at some point in the cycle, usually corresponding to sort of the cyclicality of of the VIX, which is sort of a different discussion. But then there'll be a reversion, and they'll sort of equilibrate or go back to equilibrium. And equilibrium is essentially implied vol being a bit higher than realized or historical. And so then the question here is kind of, as we're looking at this, it's like, is there more juice to be extracted? Like, how much further do implieds need to come down in order that we can get to that point where options are cheap again relative to the amount of movement that the marketplace could generate?
I would expect there to be pops in IV again, and like say in VIX, I would expect it to go back up again. But with the skew the way it is now, it's sort of, if you followed the trend of the skew, it's been lifting over time. It keeps going higher and higher versus like say a month and a half ago where the entire skew was sitting down there like around under 20%.
Yeah, and I don't want to be a mega bear here, but it does seem as if we're sort of in, how would I put it? We're in coiling territory right now.
Yeah, it is. It's building, and that doesn't mean we don't go up, obviously. But it, again, is there another event coming? We did this on a pod too, right before a big event, and we're basically going, yeah, we're super bearish here because of the way this is looking, and it's like in the midpoint of where I would think we were then. Then it was really low, and now we're kind of moved up into like maybe a midpoint, the coiling position. And so I don't know what's coming. I don't really care. I just know that this has the look of essentially the near-term IVs going back up again.
Yeah. Although I remember,
I think the right side's going to go up first, personally, but I think this skew is going to get elevated.
I do think that we kind of, especially after, okay, this may be unfounded, and you'll break it down, but I think we got to tap 400 again.
No, I 100% agree. Actually, I don't know why, but and we can look at that spike, that closing spike X, and get a pretty decent idea of why. It just looks so lopsided.
Oh yeah, I mean that's why it's just that there's still enough down here that relative to how much there is up here, it's still unbalanced, like you said, right? So it's almost like what we're gonna have to do is run all the way back up to 400, squeeze everybody again. You sent me an OI. Let me pull that up. That's what we really should be looking at for this actually. This guy.
Yeah, exactly. So you could see for March 31st, which would be, on this chart, it's 9 DTE, but 72% of all the open interest on this chart expires on March 31st.
Yeah, I was looking at that as a very significant. It's also the quarterly expiry. It almost, and then I was also looking at the discrepancy between realized and implied and historical is closing, but I was looking at I have like this comparison with indicators on Thinkorswim, which I don't have up right now, but it looks to me like there's a little bit more of that gap to fill. So it makes perfect sense for us to ramp up into the quarterly, despite the fact that we're in a window of weakness. And then after that, we could definitely see us start to curl over because none of the risk factors have actually gone away.
Well, that brings us back to the risk factors of the banking situation. But I just want to highlight this real quick. I really like looking at these charts here and highlighting and seeing what percentage of the positioning is expiring and what the composition of those positionings are. What's the net balance? The net balance for Friday is puts. Okay, so it's going to be really hard, in my opinion, for the market to go down without a significant event. And I highly doubt those puts pay out. I don't think 390 can even break this week. Mm-hmm. It may get tested. I don't even think it could get tested unless there's another event of some sort, especially we talk about banks. So with them essentially pumping in another, 393 trillion or billion, sorry, almost half a trillion onto the Fed's balance sheet again, that was almost all the QT that they've been working on for months. And they basically just put it all back in 2 weeks.
We all do this, right? It's called procrastinating. They're just procrastinating, and then when it hits, it's going to be even worse.
Right. Well, so this is something Jim always talked about is the Fed's job a lot of the times was just to extract volatility out of, basically compress vol. And so that was a really vol compressing event, is when they came in and essentially saved the depositors. And something he talked about on TD Ameritrade was that it took out it took out tail risk from the market. And it didn't necessarily mean that the Fed wants the market to go higher. It just meant that the market's not going to crash.
Yeah, I mean, I would kind of argue that it let's say it takes out the 360 tail risk and then it adds the 300 tail risk.
Why would you say it adds to 300? Because they didn't completely fix the situation. The situation's still there. They just put a Band-Aid on it.
Well, I mean, it actually pissed me off a little bit, to be honest, because they did multiple different things at the same time. The big factor that's adding to the tail risk is just the inflation fears, which now all of a sudden, because we have this banking crisis, nobody's thinking about the inflation stuff anymore, or at least it's out of the headlines for a bit. But the reality is the whole reason that we're doing this is to fight inflation. As soon as they pump all that money back in, they're undermining their own fight against inflation. And that exposes us to sort of global and other inflationary risk factors, which have always been the case, whether it's deglobalization or whatever, the stuff that we were talking about months ago. The other issue is that when you or I deposit money underneath less than 250 grand into the bank, we are by default, or those banks are paying, right, FDIC deposit insurance to protect our deposits. The fact that the Fed just backstopped the deposits of depositors who had in excess of $250,000 means that they essentially remove the obligation of those depositors to do their due diligence in terms of the institutions that they bank with. And even though those institutions had not been paying for insurance, they were given insurance. That to me actually undermines the value of my insured dollar, because my insured dollar costs me more to insure than that insurance is worth, because that insurance is worth nothing.
Okay, I real quick, I agree with you that the risks on a global scale systemically are higher, but they didn't actually backstop all depositors. They only backstopped a specific set, right? So
Yeah,
it wasn't like they said, okay, we're just going to backstop all deposits. Yellen actually came out and said no. Of course, perfect timing, the way she came out and said that at the top of FOMC, let's say. But, and then at the lows on Thursday, she came out and said, well, we may do it. So, but they're not going to do that yet. We don't know, but they haven't done that yet. So your 250,000 insured dollars are still have some value, because there's no guarantee that they're going to backstop anything above that.
Yeah, no, it's just they have been incrementally reduced, or it's sort of unclear. It's this funny game that they're playing where, right, the rules are the rules until the rules need to be broken. And this was like a really clear instance of that, right? Like vagary, ambiguity. It's almost like we get so much clarity around Fed. And sorry, this is a bit of a tangent from the actual market stuff, but we get a lot of clarity around Fed policy and broadcasting and all this stuff. And yet I kind of am starting to understand a little bit better why the market always wants to doubt the Fed. And it's because when shit does hit the fan, the rules will go out the window. And they kind of always have.
And she said that. She was in a hearing yesterday, I think, where they asked her basically, and she just said, yeah, if your bank is gonna, if your bank goes down and it's gonna cause systemic risk, then we're gonna come in and save it.
Yeah.
And so that right there, I think, points to it kind of alludes to your point where you're going, well, people don't have to do their due diligence. Put all your money with the huge, too big to fail bank. And if it goes under, we're backstop. It doesn't really matter.
Well, and the issue that I have with that is that it incentivizes malinvestment.
For sure. But it does reduce volatility. It does compress volatility, and it takes out tail risk, because now all the too big to fail banks, or if any bank is going to cause systemic risk, it's backstopped. And so,
yeah. It postpones everything. And when I say postpones, I'm not saying next month. I'm like saying 5 years, 10 years from now. Like they're
yeah, but who cares about that? We only care about Fridays. I mean, if you're a long-term investor, you really do care about that kind of stuff. But if you're like a Warren Buffett, you don't give a crap, because you're just buying businesses anyway. So you can basically remove the risk yourself by just going and buying real estate, or just going and buying a bit. You don't have to buy stocks. So
that's true.
Anyway, so the point, what I'm saying is, tail risk was taken out. Doesn't mean risk was taken out, but seeing a 360 or seeing a 370 next week, I highly doubt it. It does not seem possible unless for some reason there was another tail risk event. But everybody's sitting in puts for Friday. They're sitting here on a clock, and I think every move that tries to go down gets bought back up into even 400, maybe even 405. I'm still not convinced that we don't see 405.
Yeah, no, I would not. I think like there's a real possibility of an intense rally here because of that, of all the all the bearishness that just got caught off sides by that, right? And that move needs time to unwind, so to speak, right? It's like everybody was getting hyper bearish, and then like with FOMC in particular, got caught off sides, and now, like you were saying, it'll take some time for the insured people to bail on their put insurance. And as that happens, it's just going to sort of like gently bring us up until all of a sudden we're ready for the next vol event, which is probably not going to be until we get another FOMC or something like that.
Yeah. And so let's look at the VIX for Wednesday.
Yeah.
Folks always, I'm still debating whether you gex the VIX, right? Well, let's look at the gex up there at the top. Looking at the chart here.
Okay. Yep.
And so this is closing yesterday, closing look. And I talked about this in that morning video on Friday. It was, basically we're looking at a VIX where we opened at a put wall and a call wall at 24.25 and the biggest gamma level. And the zero gamma line was about 22.23. And so I was saying, like, look, this VIX doesn't look like it's going to go much higher. It just doesn't seem like it's possible because it's sitting here at resistance and the zero gamma line is below us. And that essentially would mean that there's a lot of positive gamma to essentially expire or to decay, or people are exposed to the upside a little too much.
Yeah.
See a move back down towards the 21.
Well,
That's exactly what happened.
Yeah. No, it makes perfect sense.
Exactly. So we're still sitting in this situation where, okay, well, now we're potentially at a floor in the VIX, and we saw that on the skew with the IV levels and where the skews were, that we're probably at a floor of the VIX. I would not be surprised to see Monday, Tuesday being sells, or being sell the rips is essentially, and then Wednesday through Friday being just a bludgeoning of bears. That's sort of my plan.
I mean, that makes sense to me. I think, yeah, I mean, it's kind of open to whether, well, actually, if I look back at SpyGex here, it's not, yeah, we don't have anything that's in really, really close proximity except for these 395s, but most of those are probably kind of far away. So it does kind of make sense for us to come back to around the 390 and then people to recognize, hey, there's no way we're going to break this. And then that leads the next round up. So that makes sense.
Like I sort of like my ideal situation, if you were to ask me, would be Monday, Tuesday, see VIX start slowly coming back up to that 25 again. And then all of that expires on Wednesday. And then we see again another cycle of basically underperformance in VIX, and we just get a crush.
Yeah.
That's sort of my ideal situation. We get a crush back up to like 405. And maybe, I don't know, maybe even higher. I don't want to say higher, but 400, 405 area is sort of where I'd be targeting. And then we can finally get what all the bears are hoping for. But I would still need to see the conditions meet up again, because right now it's looking all bullish to me.
Yeah. Let's see. Drawing some really excellent lines here, which are going to reveal everything to everybody.
No, these are those main trend lines people have been following, right? So
yeah.
So seeing maybe another move down into that 390, and then maybe coming up and trying to tag that trend line even 310.
Mm-hmm. Yeah.
And then you got the previous high, which they, who knows, they could come. They've already taken out the previous double high, and then they sold it. They may even try to take out this high. That would be insane.
Yeah,
but
the
market doesn't make sense.
One of the funny things, like, it's actually going to be kind of fun for us, I think, because like we're in this like fun range of like what do you call that? It's sort of like a volatility box or something like this, where it's like between 390 and 400, we just get like boom, 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 like whippy moves, which are really fun. But then the broader market for investors and whatever just goes absolutely nowhere. So it's just a holding formation, and I feel like
we just got to play the box, man. Play the box until it breaks, and it's not going to break without some, one of these big expiries will break it, I think. And so that brings up another point. Let's look at so what I'll do then is, like, if I kind of have an idea of where I think the market is going to go by Wednesday and then by Friday, which we sort of have a plan what's going to happen afterwards. We can kind of see what the VIX is looking like for the next expiry, but this is a big one. And they're still bullish even into the next expiry up to 30, but it's the same kind of thing.
Let's see here.
I'll send it to you here.
Okay, yeah, no worries. I'm making this like beautiful box here.
So this would be right after, end of month, end of quarter, beginning of month flows, and then we got VIX expiring again.
This guy, yeah?
Yeah, that's it. And so we're looking at a same kind of thing where, you get the 26, 25 being sort of the top, and you got an outlier here at 30, but you still got the zero gamma sitting here at 23. So every time it goes up into 25, 26, I'm thinking that's a low for like a little swing low, intermediate on SPY.
Yeah. No, it makes a lot of sense. And what do you know? The sigma's right here for the.
Yeah, exactly. Yeah, that too. Yeah. So, all those kind of confluence together, which again, it says the volatility probably isn't over even after the end of quarter. But who knows? We could just be higher and just be in a higher range, right? Say they get us up to 400. Okay, well, now the range may be 405, 395.
Yeah.
And we're still at a high VIX, but SPY is higher as well. And Jim talked about this as well one time. He said before the big crash, you'll probably see VIX up, SPY up. And it's sort of playing out that way again, where you're going to have a higher elevated VIX, but then you're going to have SPY going up as well. And making, kind of carving out higher ranges. And then I'm guessing the final nail would be just some blow off top. But I'm not trying to project out too far. I'm just looking out till after end of quarter, where the volatility doesn't look like it's going to end, which is great. But where is SPY going to be? It's probably going to end up being in a higher range.
Yeah.
That's what I think.
Yeah. Grind. Higher range, giant crash. Sounds like a play.